Welcome back. You're watching the first trades, and let's look at what's happening in the FNO market with FNO 360 powered by 5 Paisa. The index is down nearly 1% and slipping below the 24,000 mark, and we're seeing a hectic activity of call writing happening at 24,000 as we speak. The April futures is at a premium to the spot there, with open interest up in morning trade. If you look at the May series, you'll see that a lot of open interest position jump which is happening in the Nifty, and that's specifically because of the rollovers that are happening on the Nifty there, with the premium there at nearly 120 points there. Let's look at Nifty Bank. The Nifty Bank is also weak in today's trade, with bank index nearly down 0.8%, trading at a premium to the spot, and then there's a mild increase in open interest which is happening in Nifty April series, but the May series is seeing a significant jump in open interest, 5% jump. Till yesterday we were sitting on nearly 24 to 25% rollover in both the Nifty and Nifty Bank there. If you go to the snapshot of Nifty Bank, which consists of the many companies there, as you see, ICICI Bank, ICICI are seeing either a long unwind or short position getting built up. PSU banks are down, SBI down because of the shorts build up happening. For the last 2 days, we've seen small finance bank adding long positions, but overall it's the index is down nearly 444 points as we speak. Let's look at what's happening in the April 28th call and put writing, which is there. Now the action is also shifting to the next week, which is the first week of May, but for April you're seeing a lot of call writers adding position in 24,000 strike. 24,100 is also one of the most actives as we speak. But the distribution chart will show you that the call writers are at have an edge at 24,000 level, and that's going to be some issue for the index if it stays the way it is. Then we are looking at an Nifty closing below 24,000 by the end of the day. But future gainers include stocks like Hudco, where there's a short covering. Cochin Shipyard is seeing a short covering. Oil India is seeing some short covering. So 4, 3 and 2% up these stocks in today's trade. Future losers also has stocks like Adani Energy, where there's a long unwinding happening. LTM after the earnings, there's a long unwinding happening, 4% down today, and Waaree Energies is also seeing some short build up with the futures down nearly 3.4% in trade. Open interest gainers include stocks like Cipla, where there's a short build-up. Indian Hotels is seeing a short build-up, and Kalyan Jewelry is also seeing a short build-up. Open interest down up nearly 5 to 6% in these stocks. In the losers pack, from an open interest point of view, you have stocks like BDL, where there's a long unwind which is happening. Jubilant Food is seeing some short covering, and so is Astral seeing some short covering happening there. Well, let's look at stock options, which is the most active today. It's the Infosys day, 1300 April call. The premium is down nearly 9.5 to 0.75. Open interest up nearly 3.02 lakh. Remember, there is just 2 days left for the expiry, so there's a lot of play happening on Infosys April series there, and the index is just hovering about below the 1200 mark there. But in the put as well, there is a lot of activity which is coming in Infosys, with 1200 April put being the most active. The premium down nearly 2.3 and open interest up nearly 3.74. So as we speak, the index is below 24,000 and it seems that there's a lot of call writing happening at 24,000 level, keeping the index muted at this point in time. Right?
Okay, thank you for that, Sajid. Of course, weakness is visible below the 24K mark. I'm curious to know what Kunal has to say about that, because he was tracking that level very, very closely. But let me switch focus. Global uncertainty continues to worry the street, but amidst the volatility, the bigger questions are that can surging crude derail India's growth story, and is the FII exodus merely cyclical or a deeper structural shift? Also, where will the next profit pools emerge from with regard to this point onwards? We decode this and much more with Citi's K. Balasubramanian on this edition of The Interview with Ayesha Faridi. Listen in to an excerpt of that chat.
FIIs have been net sellers to India now for more than a year, and quantums as large as we've not seen in our history ever. Is that going to continue? Purely because of the relative outperformance of other emerging markets and even developed markets?
See, at the end of the day, FIIs are basically looking at returns, right? They don't have too much of association to any particular country because they have to make the money work. India, for a variety of reasons that we spoke about in the last 12 months, was not the top pick from an investment perspective. But then if I look at the tailwinds that is coming in terms of like, the tariff regulations coming into play, the second thing is the local consumption continue to be a big positive driver, and the corporate performance is starting to improve. It's only a question of time before the money will start again flowing back to the country. Some of the money that moved out of India basically went into some of the other emerging markets in Asia. And if you look at the return on a relative basis in the last couple of quarters versus what it was 12 months back, I think that has started to moderate, which means that there is going to be reallocation of portfolio that will happen, and India potentially will start seeing to get the benefit. When it is going to happen, our view is that it's probably sometime in 2026. We have to wait and see in terms of how that plays out.
So you're still saying that the FII reversal is more of a cyclical story and not a structural issue?
Absolutely not, because fundamentally for the reasons that I started talking to you about, nothing has changed, right? It is only that short-term hiccups which resulted in money moving out of the country, but I think it is a question of time before it starts coming back.
But Bala, you in your conversations do speak and advise a lot of these FII investors as well. When they talk about India, what are the three signals that they're waiting for?
I think corporate performance is something that they're super focused on. We saw a pretty decent December quarter performance. We are still waiting to see in terms of how the March quarter numbers are going to come out. The initial indicators show that even the March quarter traditionally is a very, very strong quarter for India because of the financial year end. Should be a good quarter. So I think that is going to be a big positive. The second thing is in terms of the government views in terms of how they are helping the economy. And as I said, that government has been super supportive in terms of trying to ensure that there is enough and more interest in sectors across the economy. So that again is the second thing. And the third thing is the macro environment, right? With everything that is happening globally, if you have to look at one place of stability, which is still, I would say India is right up there, because Europe is going through its own churn. Middle East, unfortunately, is going through a war. I don't know how long that's going to take. US, we are getting into the midterm, so it's a question of time before how that changes. So considering all this backdrop, if you put India versus some of the other factors or markets, I think India should start seeing flows coming back.
If I were to ask you in the next 1 year, where do you see the maximum profit pool getting created?
I think the good thing, Shah, is that, if you look at the corporate balance sheet as well as the bank's balance sheet, I can tell you that, they're probably the best in the last 3 decades that, I can think about. And this is all the hard work that the government did in 2015 to 2018-19 period, which ensured that the relative position of both corporates and the banks are probably the best that India has ever seen. So, and most of these corporates are basically looking at avenues for growth, and those avenues could be either domestic or it could be offshore. We are seeing a lot of activity happening on the pharmaceutical sides, especially, where companies are basically looking at assets in different parts of the world. And that's going to be a continuing theme that is going to play. And we are involved in several of those conversations and discussions. The second industry that I will talk about at Autocomp, I think increasingly, the demand is to look at distributed model. There again, there is a lot of investments happening where Indian companies are basically looking at opportunities outside India, either for organic or inorganic growth. So that's a continuing theme that is going to play. IT, we talked about it, AI is going to be a big driver. There will be opportunities for bolt-on acquisitions in different parts of the world, and Indian companies are basically looking at that as well. So you will start seeing a lot of outbound acquisition happening from India. And in fact, the recent guidelines that RBI came in, where they allowed the domestic banks to also participate in acquisition financing, that basically means that the pool of capital that is going to be available, as well as the cost of liquidity that is going to be available, is going to be much better than otherwise what was available. So that basically will further provide a pivot to some of these companies to look at opportunities for growth. And domestic opportunities continue to be pretty strong with the large consumer base that we are talking about.
So you're saying a brighter next 1 year?
I would think so. You will start seeing some of those deals getting announced. The capital market, again, if you look at Indian capital market, it's normally a back-ended capital market because majority of capital raising on the equity side happens between, say, September all the way into December. And if I look at the pipeline that we have, as well as what the street has, I think the size of the transactions that we are going to see in 2026 is going to be much, much larger than what we've ever seen. And with some bit of tailwind coming in and some bit of the clarity emerging on the current situation, we strongly believe that come Q3 and all the way into Q4, we are going to be quite busy in terms of the opportunity for the capital markets. On balance, if I have to look at the positives that is weighing for India versus the near-term shocks that we are going through, there is still a lot of money which is waiting to come into the country, both on the portfolio investment side as well as on the FDI, which is the manufacturing side. And the primary reason why I'm quite bullish about this is because, one, there are not too many countries which potentially can give a market which is as big as India, quite a resilient market. So that's a big draw for investors across sectors. The second thing, which again is super positive, is the fact that we have a government which is in its third term. So consistency is something that is very critical as you're looking at investing from a long-term sense. And I think India, thankfully, is one oasis in a desert where consistency is something that, is very positive. Predictability, again, has been pretty positive is what I would say, which again is a big factor when investors are looking to come into the country. And the last thing is the government has been very proactive in terms of trying to improve the ease of doing business as well as opening up avenues where investors could be interested in putting money in. So combination of all these things basically ensures that, the positives more outweigh the negatives.
When I just look at the texture of the listed pool here in India, Bala, what is the sense that you're getting? I mean, of course, the index weightage aside, but in your conversations, where is it that you see structural stories getting built in India, which is getting reimagined as we speak?
I think the digital story in India is very, very strong. The financialization of savings that is happening in the country is very, very strong. The third thing is India is no more restricted to the top 10, 15, 20 cities. It is much, much more broader. There are activities that is happening in places which hitherto you wouldn't have even talked about it. The number of airports that is actually getting constructed in tier 2 and tier 3 and tier 4 cities in India, that basically will mean that, the pressure on some of the big cities is actually going to reduce over the next 5, 7, 10 years' time. And there is going to be more and more availability of opportunity across India. Now, if I take an example of what is happening in consulting firms and what's happening in IT companies, today a large part of the workforce is not going to be in the top 10 cities in India. They're actually getting into some of those newer places like Orissa, some parts of southern India, not the traditional Chennai, Bombay, Hyderabad, etc., but some of the other places where the quality of talent is equally good. Attrition rates are much lower. The cost is much cheaper. And people have an option of staying with family instead of moving away from family. That means that, the pull factor for these companies to go into those markets is only increasing. So at the moment, some of these companies go into those markets, imagine the consumption theme that is actually going to start driving in those places. And then the affordability index, et cetera, will all start improving, which means that the growth is going to be more structural and more diversified rather than concentrated in few pockets.
Want to listen to marquee voices and what they're saying about the global economy as well as how India is placed in the midst of that global economy. And in an exclusive chat with Gita Gopinath, my colleague Sajit Manga discussed the ongoing West Asia tensions and the impact of that on the globe, especially India. Is the India growth story intact amid such disruptions? Listen in to a slice of that conversation.
The West Asia situation is clearly still evolving, and we still have the blockade of the Strait of Hormuz. And so in addition to prices of oil and gas and fertilizers and helium and sulfur and many other commodities prices having increased, you basically have shortages of some kinds of commodities, like for India, in the case of cooking gas, LPG, the shortages that are coming because there's simply just no ships taking fuel out of the Middle East into, for example, India. Among the countries in the world that are most directly impacted by the developments in Iran are basically India. I mean, India is one of the countries most impacted because it relies on imports of oil and gas and fertilizers from the region, but also because it relies on the Middle East as a supply chain hub. It's what India uses to send goods to other parts of the world, and also because of the reliance on remittances. So there are multiple channels through which this is affecting the Indian economy. I mean, growth is expected to be around 6.5% for the Indian economy this year because you have this negative effect that's coming from the war in the Middle East. Some of that has been offset by the lower tariffs now that India has. It was supposed to be 50% that the US imposed on India, and now it's down to 10%. But still, you do have the negative effect that's coming from the war. And again, this is a developing situation. So, depending upon whether this crisis lasts for a few more weeks, you could see an even larger impact on the Indian economy.
Some would argue that this oil shock is a little different from the previous one where we saw oil jumping three times or four times the price. At that point in time, the supply side impact was only 7%. Now it is around 20% of the global crude requirement which goes through that Strait of Hormuz. And still, we don't see the kind of spike that we have seen in oil. Is this a different kind of shock from what we are used to see whenever there is an oil shock in the past?
So what we've seen differently this time is that it's not just firstly that the price of some of these commodities have gone up, but also just simply shortages in terms of supply availability, right? I mean, if you could get ships to move through the Strait of Hormuz, you would get them, and you would get some more supply on the market, but that hasn't been happening. I mean, the last time round in 2022, when you had Russia's invasion of Ukraine, the biggest increase in prices came from natural gas, and that came for Europe. I mean, that's a very segmented market, a fragmented market. Not all parts of the world are equally affected in terms of gas prices. But that was a very different reliance that Europe had on fuel coming from Russia. This time it's a different matter. There's also been a lot of diversification. Thanks to the 2022 episode, countries have moved in buy their fuel from many parts of the world. We've also seen a shift towards renewables in many parts of the world. So all of that is helping. But we're definitely not out of a difficult place at this time because we still have a blockade and it's still ongoing. And we could still see accidents in the Middle East that could lead to much more longer term disruptions. Also, what's compared to 2022, what was different was that it was not just that there was a supply shock and there was lesser commodities available, but that was a time, if you recall, that we were coming out of the pandemic lockdown. So demand was surging, and that surging demand met lower supply. And so that's why you had prices go up much more than what we're seeing right now. Right now, we don't have that big demand surge.
What is your assessment of how it's going to impact India in the medium term, especially from the point of view of food, maybe fertilizer and fuel?
Yeah, no, the concern is, of course, that if, again, this war doesn't end soon, then again, shortages of fertilizers will affect the crops, the sowing season, and will affect agricultural output several months into the year. That's what we saw the last time too, and you can see that prices could go up in the future. Right now, because there are some contracts that were set, there were longer term contracts that were set previously. those kinds of price effects are not showing up. But it usually comes with a lag that you start seeing an effect on food prices. I think one of the things that India has done well is to increasingly rely on renewables, and that's helping. And I think this crisis tells you even more the need for energy independence and ramping up even further and at a faster speed, being able to rely on renewables, especially on solar being a very important part of that. That will help further insulate the Indian economy against events of this kind.
Well, you can catch that full interview of Gita Gopinath only on ET Now. But let me quickly switch focus. The US has imposed a steep preliminary anti-dumping duty on solar imports, hitting India with tariffs of over 123%. Players like Waaree Energies and Vikram Solar could face near-term pressure. Karan joins in with the details.
Well, there's an update on the anti-dumping duties levied by USA on the solar cells which are imported from India. The US Commerce Department on Thursday has announced a preliminary set of anti-dumping duties on the solar cells and the solar panels which are imported from 3 countries, namely India, Indonesia and Laos. Diving deeper into the rates of these duties, it's 123% for imports from India, followed by 35% from imports from Indonesia and 22% from imports from Laos. An interesting point to be noted here is that earlier the duties were in the range of 81% to 126%. So there's a change in the rates now. The 3 nations, that is India, Indonesia and Laos, last year accounted for roughly around $4.5 billion in US solar imports, and that is about 2/3 of the total. Diving deeper into what are the specific Indian companies which will be in focus on the back of this development, we have Waaree Energies and Vikram Solar in focus. However, in case of Waaree Energies, the company already has a facility in the US. Diving deeper into the capacity profile of Waaree Energies, the present module capacity for Waaree Energies in US stands at around 1.6 gigawatts, with further planned capacity expansion in the US to the tune of 2.6 gigawatts. And the timeline for this execution is FY27. Moreover, the management of Waaree Energies had recently confirmed by way of a con call that they can effectively bypass these set of duties in future. Taking a look at the order book of these 2 companies, Waaree Energies' order book stands north of around 60,000 crores, with a 33% exposure towards the US markets, followed by Vikram Solar with an order book of 10.6 gigawatts, with a 16% exposure towards the US market. On that note, do watch out for Waaree Energies and Vikram Solar.
And you're seeing that knock on the stock price. Switching focus to Adani Energy Solutions, they posted a steady Q4. Revenue up 15% odd. Profit came marginally higher at 723 crore. Adjusted profit jumped nearly 28%. EBITDA grew 5% to 2372 crore. The company says growth was driven by transmission, execution and strong momentum in smart metering. That was really what really stood out, frankly, the execution in smart metering. We spoke with Kandat Patel, CEO of Adani Energy Solutions. He says the FY27 outlook looks optimistic. Listen in.
From a balance sheet and capital management perspective, we remain focused on maintaining financial discipline even as we scale. Our improving credit profile and recent rating upgrade reflect the strong lender and investor confidence in our business model and a long-term cash flow visibility. Looking ahead, the growth outlook for Adani Energy Solutions remains encouraging. We have a robust transmission pipeline of nearly 72,000 crores under construction with a near-term tendering opportunity of around rupees 1 lakh crore.
Okay, and switching focus to LTIMindtree, or LTM, formerly known as LTIMindtree, delivered an inline Q4 with modest revenue growth, but margin pressure from wage hikes and productivity commitments. While BFSI weakness weighed on the performance, strong deal wins and a robust pipeline signal a potential AI-led recovery in FY27. Darshita joins us to tell us why brokerages have trimmed estimates.
LTM's Q for FY26 was largely in line with a few key takeaways. Looking at the top line, the revenue growth was modest. The dollar revenue growth was 1.2% QOQ and the constant currency growth was 1.4%, while the rupee revenue grew stronger at 4.7%. Moving on to the margins, which were the key pressure point here. EBIT margins declined by 100 basis points, coming to 15.1%, which was mainly due to the wage hikes and some productivity measures. But the PAT, however, jumped over 43% QOQ, which was largely driven by non-operational factors. Focusing on the deal momentum, which continues to stand out, order inflows came in strong at $1.69 billion, marking the sixth straight quarter above $1.5 billion. The full-year deal wins grew over 10% YOY to $6.6 billion, led by large deals. But the BFSI, which saw some weakness, down 5% QOQ due to delay in a key client issue. But management expects recovery from Q1 FY27. Looking ahead, FY27 is being positioned as an inflection year, driven by AI-led demand and large deal ramp-ups, with gradual margin improvement expected. Brokerage remains mixed. Citi and Jefferies stay cautious, while the Goldman Sachs, Morgan Stanley and UBS are neutral. Nomura, CLSA and JP Morgan remain constructive. Overall, a steady quarter with deal execution and BFSI recovery as key trigger points.
Okay, the other one buzzing in trade is IKS Health. It's announced its largest acquisition to date, agreeing to buy TrueBridge in a deal valued at up to $565 million. The acquisition marks a strategic push into rural and community hospital technology in the US, a segment with strong demand for digitization. Meryl joins in with the details.
Yes, IKS Health is in focus today after announcing its largest ever acquisition of TrueBridge with a deal valued at up to $565 million. Now, from a strategic perspective, this acquisition brings in capabilities like revenue cycle management, which is expected to be the combined entity's key growth driver. There's also an added focus on electronic health record expertise, which is going to help IKS expand beyond services into a more sticky, recurring SaaS-led platform business. Now, there's also a lot of mention on agentic AI, along with human expertise, which is considered to be the most suitable model, especially in health tech in this current AI environment. Now, they've also mentioned access to broader clinical as well as financial data, and they're going to be seeing an overall improvement in intelligence and automotive capabilities. But the important factors for investors to watch on the back of this acquisition remain first and foremost the debt profile. This acquisition is said to be financed primarily through debt. IKS has secured a $670 million fundraising package, which includes $610 million in term loans, a $40 million secondary term loan, and a $20 million revolving credit facility. After this acquisition, the leverage is expected to be around 3 times the EBITDA of the combined entity. So that's going to be an important one for investors to watch.
Okay, thank you so much for that, Meryl. With that, completely out of time on this edition of First Trades. Thanks so much for tuning in. More action to follow. Stay with us here on ET Now.
And over the course of next half an hour, we'll tell you what's really happening in the markets. And let's start with the movement on the index front, because yes, of course, we have seen Nifty breaking below that 24,000 mark on an intraday level, and it's up that 24,000 mark, trading close to that 24,960 odd levels. When it comes to Nifty Bank, more than 300 points of cuts is what we are getting to see. And yes, of course, the IT pack is the biggest loser for the markets right now, and it's not just the large cap IT names that are down in trade today, but the mid end of the market within the IT space is also is also very much hammered in today's trading session. But let's move on and let's put the spotlight on Tata Capital. Then we have Mr. Rajiv Sabharwal, who is the MD and CEO of Tata Capital, joining us on the show. Hi, very good morning, and thank you so much for your time. And first up, let's talk about your credit cost. We see that your credit cost has declined sharply in Q4. How do you see the sustainability of this going forward?
So if you look at, what we've been doing over the years is to build a culture of risk management in the organization and getting the message through that risk comes first. We've always been very focused on credit quality. We've used data extensively in making decisions, use scorecards a lot. So all of this has helped us over a period of time to improve credit quality. We saw especially credit quality improving on the retail unsecured side post quarter two. Quarter two was better than quarter one, quarter three was better than quarter two, and quarter four was better than quarter three. So we believe that we've built a portfolio which is very resilient, and that along with our focus on doing collections based on a lot of data is also helping us. Of late, we're using GenAI extensively to make calls and give propositions to customers.
Okay, and Mr. Sabharwal, also help us understand how your other metrics are going to be shaping up. See improvement from quarter one onwards?
So if you look at one of a few things which have worked very well for us, one is the growth. Growth has been extremely strong. If I exclude the motor finance business which got acquired, our growth was about 28%. Credit cost, as you saw, has come down and clearly stands out as one of the best in the industry. The other is operating efficiency is also improving. Our cost to income has come down by over 300 basis points compared to last year. As we look into the future, I am pretty optimistic on growth. Our guidance for FY28 is this, that we will grow at about 23 to 25%, and we are working towards the same. We believe the potential exists for us to continue on our growth journey. We also expect further improvement in cost efficiency to coming with more use of data technology and now GenAI. A lot of projects are happening in that space. We also expect the quality of the book which we have created to sustain over a period of time. The other thing which we are trying to do is improve the mix of high margin products in our total business, which will lead to margin improvement also. So it's a combination of this which we believe will help us to further improve our ROAs.
All right, along with that, Mr. Sabharwal, how are you reading the risk of West Asia crisis? What are the concerns that you foresee with respect to the geopolitical situation right now?
So if you look at what's been happening, we've seen the government pretty focused on ensuring that the impact is minimized. We've not seen any impact on fuel prices. The other thing I think every corporate is conscious of and every MSME is conscious of is that they need to ensure that the supply chains keep running. A lot of them have carried raw materials for 3 months or so, which is ensuring that their productions are not disturbed. We are also hearing from them that they are getting raw material, maybe at higher prices, but they are able to access, which is ensuring that the production goes on. Consequent to this, when we reviewed our portfolio, we did not see any impact as of now of the West Asia crisis. However, this is something which we continue to watch, and we will watch this two segments very closely, the MSME and the commercial vehicle segment.
Right, okay. And Mr. Sabharwal, there's been a noticeable uptick in your corporate lending. Are you consciously taking more wholesale exposure at this point in the cycle?
So if you look at our book, our total book, retail plus SME forms about 86% of the total book. So we are largely a retail and SME, with the largest segment for us being the housing finance business. In fact, the housing finance business now forms about 30% of our total book. However, we do look at opportunities where we can get lending on the corporate side. So we try to maintain a mix. In fact, the way we are looking at the next year, we expect housing and retail to grow at a faster pace, and you will see that proportion growing in the coming year.
All right, but what gives you confidence that motor and unsecured book will grow well over FY27? Now, what sort of an industry-wide improvement are you expecting?
So if you look at motor finance business, we acquired this business in May of last year. the business, we could break even in the business in Q3 of FY26, and in Q4, we make money in that business. We do expect that this to keep improving with every quarter. As far as retail unsecured is concerned, we have always said that the steps which we took over the last 2 years will help us bring down credit costs, and that's played out exactly the same way. Our Q2 credit costs were lower than Q1, Q3 was lower than Q2, and Q4 was lower than Q3. And looking at all early trends, we expect this to continue. We've embedded a lot of scoring. We've embedded a lot of now unstructured data, which we use also along with structured data to make those decisions. And those credit models are continuing to hold very well. So we are pretty optimistic that the credit costs, both on the motor finance business as well as on retail unsecured, will be sustained at lower levels.
Okay, well, that sounds really optimistic, Mr. Sabharwal. So I'm just trying to get a better sense. Concluding everything that you've said so far, can we positively conclude that all your engines will fire heading into FY27? And if you could help us understand any risks of that not translating, any potential headwinds that you're noticing at the moment?
So if you look at, growth, we're fairly optimistic. As far as cost to average assets or cost to income is concerned, we've embedded a lot of technology and are increasingly using more GenAI in our operations, which will help us bring down our cost of doing business. Credit costs, we are looking at all early indicators, starting from the bounce rates to looking at our early stage collections. All of them are showing a positive trend. So I don't foresee any problem at this point of time. But more importantly, we have a very agile and a nimble team. If we detect any problem, we are quick to take action on the same. That's what we have done in the past, and that is what we will continue to do in the future. We are extremely data-driven, and we have a team which knows that risk comes first before business.
All right, and along with that, Mr. Sabharwal, margins will move up as a result. And by how much? What is your sense on margins?
So as far as the coming years are concerned, we expect margins to improve. We expect cost to income to come down, and we expect low credit costs to sustain. That will help us to further improve our return on assets. It's difficult to quantify actually, but you will see that movement happening because the proportion of high margin products for us in our overall mix is growing.
Okay, and lastly, Mr. Sabharwal, levers for return on asset expansion, anything at play right now? Will it only be credit costs? Is it going to be a mix of OPEX, credit costs, margins? Any outlook that you can give us?
So it will come from all three segments. NIM plus fee will grow, our operating efficiency will improve, and our credit costs will come down. We have guided for a credit cost of sub 1%, our cost to income of 33 to 34%, and further margin improvement. So all three of them will play out in the future.
Okay, on that note, Mr. Sabharwal, thank you so much for your time today. It's been good chatting with you, and good luck for the quarters to come. Viewers, with that, it's time to slip into a very short break on this edition of Midcap Masala. When we return, we'll have more corporate conversations lined up basis Q4 earnings reaction. So you stay tuned and we'll be right back. Talking to you about your new facility. Your Himadri facility in West Bengal is now the world's largest single location SCB facility. If you can help us understand with what is your utilization target for FY27, by when is this going to be fully operationalized? Any update if you can give us?
So thank you for having me. And we are very happy to announce that this is the single largest capacity for specialty carbon black. And not only that, Himadri unit is one of its kind, fully integrated complex in the world, with full backward and forward integration of all different product varieties. And looking at the capacity utilization, we look at 85 to 90% capacity utilization during FY27.
All right, that's great to hear. But Mr. Chaudhary, hi, morning. Firstly, congratulations on this particular facility. The investors are actually cheering this particular announcement. But just wanted to understand what sort of a revenue contribution one can envisage for FY27, as well as in terms of the margin versus the core business margin right now, or rather the consolidated margins right now. What sort of a margin will this particular anode will have?
So two things. One, the way to look at Himadri is not to look at EBITDA. If you look at, it's to look at the PAT as a percentage of top line. So for the last year, on a consolidated basis, 16% was PAT to top line ratio, which is very strong. And for the margins consolidation, we feel it will be stronger in the years to come. And I have given a clear guideline that FY25, we achieved a PAT of 555 crores. In next 3 years, that FY28, we will double it. So FY28, you will have a PAT of 1100 plus crores from that is what we are confident of achieving.
Sounds really good, and that's a lofty guidance that you've given. 1100 crores of PAT by FY28, looking very good. Let's refocus. You've highlighted Birla Tyres revival in FY26. Can you quantify the revenue contribution that took place in FY26 and the one that's expected from this in FY27?
So Birla Tyres for FY26 contributed 87 crores in terms of top line. And this we expect to cross 3,000 crores in next 4 years.
That's a good number. But along with that, Mr. Chaudhary, internationally, just wanted to understand what's really been happening, because you've been trying to expand internationally. So for FY27, what's the outlook, and how is the recent geopolitical developments impacting you and your business?
See, what Himadri has actually done over the years, we have matured our business model and have made a sustainable business. So there are uncertainties, geopolitical uncertainties have been there, and now it's at peak. But still, I'm happy to say that there has no impact on our working on, as we have no dealings with West Asia in terms of our procurement. So Himadri is completely isolated with the current geopolitical turmoils. One thing I would like to highlight that when we are talking of anode material, this is the chemistry on which Himadri is working for last more than 1 decade and have invested huge amount of capex. So today I'm really happy to see the culmination of years of dedication, hard work, commitment to research and development and innovation. See, many players can think of setting up anode plant, but what is the differentiating factor between Himadri and others is the integration, complete integration from raw material to the finished product. So we have our own, we have developed very, very high technology specialized pitch, which makes coke, and this coke is converted into anode material. So it took years for us to develop this. And the beauty of this product is it gives very high capacity to the battery. That is unique feature that makes Himadri totally different from others. And, till now, we have been giving you a strong bottom line growth. But looking forward, you will see all around growth from top line to bottom line. So in the year to come, you will see top line growth plus the bottom line growth.
Okay, that sounds optimistic. But, sir, I'm just trying to understand the way that you have reported your numbers. And, EBITDA margin has fallen to 18.8% versus 20.6%. And despite EBITDA being flat, the PAT has seen a very significant uptick of 29%. This, I understand, is led by other income. Could you help us break down what this other income components are? What is shaping up this uptick that we've seen in PAT in the previous quarter?
So, see, other income is part of the cash we have, we generally deploy it with banks to earn interest. So, and at the same time, we take from bank loan, and the amount we have invested, like for Birla Tyres, we have invested around 500 odd crores, which goes into NCD as an investment. So there we have our income. Plus, we have other investment on which we have very strong returns on mark-to-market basis. These are part of the other income. But looking forward, you will see strong growth in terms of top line and bottom line both.
Okay, so that sounds really optimistic, and thanks for breaking that down for us so nicely, sir. And thank you so much for your time. On that note, we'll let you go. So viewers, that was the management of Himadri joining us on the show on the back of their new facility for their anodes as well as the earnings, and the stock is doing wonderfully well in today's trade. It's up 10.5%. But the other stock to watch out for today has been Bluestone. That stock started with a very sharp uptick of 6 to 6.5% in the morning. You can see that spike on the charts at open, and then it has consistently fallen absolutely about flat right now, 0.5% uptick on that stock. Let's understand what the quarter four performance was, because it was a very stellar quarter for Bluestone. So we have the management, Mr. Gaurav Singh Kushwaha, the founder and CEO of the company, joining us on the show. Mr. Kushwaha, morning and thanks for your time. You know, quarter four has been a really stellar quarter for you. But before we talk about financials, can you help us understand how demand shaped up for you in quarter four, given all the volatility we've seen in gold prices? And on the back of that, if you can also help me understand your hedging policy, how much of your gold is hedged at all times?
Sure. So I think demand fundamentally has been, the secular demand trend that we see in our category is the shift towards lighter weight designs, the shift towards daily wear designs, etc. And I think over the last 5 to 6 years, we have generally been seeing that trend. And hence, our growth rates have generally been very good, given that we decided to operate in those categories. So I think last year, that one-off fluctuation that we saw in the gold price, I think that kind of distorted this secular trend and added a lot of noise in the system, where a lot of investment-led products actually saw a lot more traction than what they generally or usually see. So I think with gold prices more or less stabilizing at new normals, we see the bigger secular trend kind of taking the front seat once again, and the investment-led products kind of again receding to the back seat. So with all those things, I think we are this quarter we are kind of back to our normal growth, which has generally been above 40% for the last. So if you see the last 3 years CAGR, that had been generally around 45 to 47%, and this quarter also we've kind of gone back to those normals. And the second part of the question, in terms of the hedging strategy, we have always maintained a 50-50% hedging strategy, which I think is the best strategy to protect the balance sheet.
All right. Morning, Mr. Kushwaha. This is Shrishti also joining in. But in quarter three, you said that you are looking at redesigning your entry-level price points. Any update on this front?
Sure. So essentially, one of the biggest impact of the rising gold prices or that gold price dislocation was that the entry price points got vacated, and that was true across the industry. And as a result of which, I think there was certain softness in the lower price point products like sub 50,000, sub 1 lakh, and so on. So I think from October onwards, we had put concentrated efforts to repopulate those categories. And as we mentioned in January also, that was underway, that entire effort was underway, and we see some of, and it has, to a good extent, it has been rolled out, and we see some of those results coming in. And those results have generally been very, very positive. So I think the fundamental demand is there, just that the products were missing from the shelves for most of the last year.
Okay. And, given the move that we've seen in gold prices, we have noticed most jewelry players report, at least in their update, heightened demand for gold coins and chains, which are typically price-led but lower margin segments. Now, these are categories that you do not historically operate in. Any plans to launch products under these baskets, gold coins or gold chains or the likes, that have lower gold value and are more affordable?
See, we are, so in general, the way we operate is we actually lead by design and experience. So our moat has always been the omni-channel experience that we provide to the end customers. And a very key component of that is the design differentiation. So I think design differentiation is at the forefront of us. And we continue to be true to that. And we don't want to we don't want to generally play into these short-term fluctuations that happen in the market because of the commodity-linked nature of our inventory and our products. We are generally focused on the long-term secular trend of people moving from let's say gold-dominated jewelry to design-oriented jewelry. So basically, we generally tend to ignore all those fluctuations and just stay true to what the brand Bluestone stands for.
All right, but along with that, your triple SG has seen a sharp spike to 34% from 12% in Q3. What's the outlook here going ahead?
Sure, I wouldn't call it a sharp hike. I would rather call it a strong rebound because if you see our in FY25 also our same-store sale growth for the full year was around 30%. And I think last year, because of this noise that got added because of this gold fluctuation, there was certain, and I would say the last few quarters were anomalous, and now we are back to track on delivering much stronger SSG growth. So this is not an anomalous kind of a growth for us. This is more of a normal kind of a growth for us, and we are back to normal now.
Okay, so that sounds good, and this normalized level also looking good right now. Mr. Kushwaha, let's talk about your A&P spends. Now, as a percentage of revenue, your A&P spends have slightly gone up in Q4 versus Q3, even though it's a nominal uptick. What is the strategy on ad spends, and where would this number be as we head into FY27?
So we've generally maintained that we see, given our higher margin profile, we see that around 6% of A&P spends, the growth further. For last year, between last year and this year, in absolute terms, it kind of more or less remained flat. In percentage terms, it came down from 9% to around 6 point something. But going forward, we'll peg it at, in percentage terms, we'll peg it at 6%, which in absolute terms will keep on growing along with revenues.
All right, along with that, Mr. Kushwaha, lastly, what are your store expansion plans? Any number that you can help us with?
Yeah, so I think in general, our intention is to grow our distribution by around 20% per year. So this year we closed at, I think, around 340 or so. So we'll grow that by around 20% this year also.
Okay, so looking good, and that 20% number translating to about, let's say, 357 stores in the next year, given that you were at 340 now. But on that note, we'll let you go, Mr. Kushwaha. Thanks so much for your time today. On that note, viewers, it's been a packed show for Midcap Masala today. Thanks so much for tuning in. But stay on, because Buy Now, Sell Now takes all the action ahead.
In association with SBI, the banker to every Indian truly.
Water overflowing. What